Today, folks, we got to discuss the insanity that has been happening in the market this week. Dropping my Canadian dividend stock portfolio was worth around $400,000, give or take, and it dropped like 10 or 15,000 bucks this week, which led me to invest another few $1,000s yesterday into the Canadian high dividend yield ETF from Vanguard, which might not have been the best investment decision. I honestly think that thing has potential to drop a lot more, and I'm going to explain to you why that is in this video, including the stocks I'm looking at buying and what's going across the broader sectors. And if that is a conversation you'd appreciate, damn it, hit that like button, folks, because first and foremost, the Silicon Valley Bank news is what's been driving a lot of the market volatility, and it is bringing down so many banks with it, even though there's no direct correlation. Like, for instance, JP Morgan's down 4% this week, and in the last month it's down almost 11 to 12%. On the Canadian side of the border, Royal Bank down 2.5+%. Last 5 days, month is down 8%, but we're getting this actual normal reaction. You remember when the market started tanking last year and everyone's like, oh, safe haven, gold, crypto, get away from the markets and the financial markets. This is going to be where all the money's going to be made. And gold sold off aggressively during the market sell-off, and crypto actually sold off really aggressively. And now we're actually seeing like this normal response that you'd expect to see when banks go under. Everyone's flooding into gold. Everyone's flooding back into crypto. I mean, Bitcoin's up 20% just in the last 5 days. Like, doesn't it make any sense? And you'd think this is bringing the whole markets down or something, but the S&P 500 is actually up almost 3% this week. Who would have saw that coming? I didn't. But just getting into the portfolio itself, at the peak of this year, we were sitting around 405 odd thousand fully invested, and now we're down to 390,000. So a good $15,000 drop from the peak. On the cost basis, however, we're only down about $7,400, and I did invest another few thousand just yesterday into VDY, which might not have been the most prudent thing. There's some data we're going to take a look at that is actually making me kind of bearish on this ETF, which is scary because I have $150,000 invested in it, but I'm continuing to diversify. I've got some taxes to finish up. I'll max out my RRSP, probably buy more SCHD, looking at buying more VOO. We'll talk about TSM because tech stocks have been just crushing it for my portfolio this year. It's probably going to be my safe haven and a place of diversity at some point down the road we'll discuss. But the dividends, I'm still over 1,000 a month. The iCloud numbers spreadsheet did adjust itself, so I'm sitting at around 12,100 in annual dividends, and I'm expecting some really juicy fat passive income checks this month because most of these do pay quarterly, and we are finally at March, which will be the quarter for these dividends coming out of SCHD and likely the S&P 500's VOO. But if you guys do like my portfolio spreadsheet tracker, you want to support the channel, as always, come on over to portfoliospreadsheet.com. Link is down in the description. Use coupon code dividends. You'll get 30% off. You buy one tracker, you get one for each platform, including the one I use on iCloud here. And these are sold separately, but we do have personal finance spreadsheets as well. You buy one, you get the rest of those for free as well. But getting into this, let's talk about VDY, why this probably isn't the most prudent thing to be buying in this current market cycle, because there's a lot of fear behind this for me now because of the data that's coming out when we're talking about commodity prices and crude oil. For those of you that don't know, VDY is largely exposed to two primary sectors, 56% being financials and 26% being energy. So over 80% of this ETF is exposing you to probably the two most riskiest sectors in the current market environment, because let's be real, bank stocks are likely going to continue to see pain for the near term. To me, is a buying opportunity, and energy looks like it's starting to take a turn for the worst. We're not going to be seeing all-time high revenues and profit margins likely out of these big energy companies like Suncor, like, you know, a lot of the energy companies for that matter. The Ukraine geopolitical event, all of that seems to be subsiding in the oil price here. So I don't know what that's going to say for VDY, considering, again, the biggest holdings for energy are Enbridge, which is a natural gas pipeline company. And you do have Canadian Natural Resources, you do have Suncor Energy, TC Energy. So you're kind of taking some exposed risk with that. And that's why I think it'd be more prudent for most people to be buying things like the Vanguard FTSE Canadian Index ETF. This kind of gives you the same exposure, but with none of the insane risk behind that. If we just take a look at this, the expense ratio is way lower. It's not paid monthly. The dividend's obviously lower at 3.15%. And if we scroll down and we just take a look at the difference from the actual sector exposure here, we can see that financials only make up 41%, and energy makes up 17.7%. So big difference there, right? Huge difference. Only 57% of this ETF is exposed to those, so you're getting a much better diversification, and it's mostly the same stocks. I mean, you're mostly still in the financials. but you got Canadian Pacific Railway, more market cap weighted like the S&P 500's VOO, and we can see Shopify's even in here, so you get some tech companies as well. So I am going to be adding VCE at some point to my portfolio, and it's going to be pretty dependent on what happens in the near term with companies like TSM. Because obviously my new capital, I'm going to be buying some SCHD, still buying VDY. I think there's a good dip buy there, but I want some stability, and I think you get that with VCE. So I'm going to be watching Taiwan Semiconductors, my largest single individual stock investment I've ever made in my portfolio, and this thing has been exceptionally well. I mean, this thing's been holding around $90. It's been doing very well over the last week against the market volatility, and if this thing continues to do well, eventually I am going to sell it. I want to hold it for at least a year, maybe longer. Just depends on how well the performance does, because I've got like 35 grand sitting in there, and it's a US based stock. I'm holding it in US dollars, and luckily the US dollar has been continuing to rally aggressively against the Canadian dollar this month. So essentially, if I sell it, I convert it back to Canadian dollars. I'm making some really good gains against my portfolio that I could use to put in these broader ETFs. I'd likely use some of that money to also buy the VOO S&P 500, but again, I'm not there. This is just that I'm just formulating on. It's not like I'm doing this tomorrow, so it's just kind of advising you of my future plans here that could take a year to come into fruition. But hey, I'm still buying all the same ETFs, and I'm kind of continuing to broader diversify my portfolio. But I'm also still looking at REITs. Right now I haven't bought REITs back because I'm still very fearful of the near term and what's going to happen in the next year or two once they start seeing some of those mortgages come due. It's going to continue to see how bad the interest rate environment affects them, because we're still seeing a lot of pain. I mean, you got to be real careful buying these individually. Riocan is still up my favorite. It's almost below $20 a share again, well below where I sold it out of. So I'm maybe looking at buying this back at some point. But one of the more intriguing ones we have to talk about is Medical Properties Trust. I don't know if you guys have been following MPW, but it is the most shorted REIT I've ever seen. I mean, the short interest is over 26%, and this is a hospital REIT. Damn it. I mean, we're talking about literal hospital beds and things people need, and this REIT is down 32% year to date. In the last 5 days, down 10%. It's paying almost a 15% dividend yield here, and they can afford that dividend for now. Doesn't mean they won't cut it, but I've been watching this one very closely because the interest in it is just insane. It's one of the most talked about REITs in the US. And for those of you that don't know, Medical Property Trust, meanwhile, has had to cope with its own set of struggles. This includes one of its tenants filing for bankruptcy last year, and another that is several months behind in fully paying its rent. That said, the US population is getting older and will thus need more medical care and stays at facilities like the one this REIT operates. So perhaps it's probably a good stock to buy at a discount play here for longer term investors that are willing to wait. Now, this is one that I'm not buying yet. Maybe, who knows? We'll see. I'm just watching it pretty aggressively lately because I just think there's going to be a short squeeze opportunity here. I think this thing gets a little bit of hope in it. It could easily jump 20 or 30% overnight. So I'm just watching it, but it has been continuing to sell off really aggressively. And on the Canadian side of the border, same with True North Commercial. This one is a office focused REIT, but they do rent to the likes of the federal government. Like, they have really insane tenants. And I thought this company was going to be one of the strongest REITs for the small cap players, and it just wasn't. The thing, I don't own this. I know people that do, but devastated. Like, one of my good friends was talking about this, and he kind of brought it up to my attention this week because, I mean, it's paying a 17% dividend yield, but that's one of the reasons it dropped so aggressively here. I mean, it's down 45%. Just in this year. I mean, huge drop, biggest drop it's ever experienced. And again, that's primarily related to the 50% dividend cut. So the distribution is going to go from that 17% likely down to 8-9%. Not the worst thing in the world, but they also had to sell 2 properties. They're just trying to build up some capital. You can't really trust anything in a market like this. I think diversity is what's going to save you, and this really kind of comes back to prudently investing in a broad-based, diverse portfolio of ETFs like the S&P 500. I mean, it just seems like in moments like this that you start realizing how simple investing really is, and I feel like most people just overcomplicate it, and I kind of just always reduce it down to no more than 10% of your portfolio in individual stocks, and just keep buying some of these broad-based ETFs, which damn is something new for me, something I've only been doing for the last year, folks. But I'd love to know what you're doing and how you're surviving the market insanity. Let me know what you think in the comments below.